Well, hello everybody. This is Jim Musgrave, Research Financial Strategies, and it is a Memorial Day weekend. It's been a while since I've recorded a market video, so I hope you had a great Memorial Day weekend, and let me get the show started. So we found some interesting articles recently, and I just want to kind of give you a snapshot of kind of macro, then go into the micro. So Clearbridge is a sort of a subdivision of Legg Mason, and they have a great recessions indicator page that I refer to every month. And the bottom line is that we're in pretty good shape. The only negative indicator is a slightly negative yield curve. And so you can see we've got some cautionary items in terms of money supply, wage growth, and commodities, but everything else is in pretty good shape. And what was interesting is that they compared the 1998 to 2000 market to this market, and there's a lot of similarities. And it was interesting, you can see that their indicators would have shown the beginnings of a recession kind of in the Q2 2000. So it's fairly accurate, and right now we don't see any short-term indication of a recession at this time, which is great. And you know, at the bottom of the article, there's kind of talking about the similarities between the two markets, and the main differences. Well, the similarities is that you know, back in 1998, the market continued to climb to new highs for another 2 years, and you know, the main thing that brought the market down in 2000 was the overvaluation, speculation, and the economy was running too hot. And those are largely absent from the market and economy today. So anyway, that's the big picture with the overall economy is still doing well. I subscribe to a website called Esg Perspective, and they have a weekly snapshot of what's going on. And obviously last week was a bad week. It was continued uncertainty with the China trade talks, and that just caused the market to what we call exhale pretty significantly. But overall, the S&P 500 is up 12.58%, but is down off the highs about 4.2. And again, it was just last week was just an ugly week all around, and on Friday we gained back a little bit of ground. We could certainly see more pain to come, and you know, it's just the market is driven by the headlines with the trade talks, and that's how it's been for the last year or so. So anyway, that's, I don't have any more to report on that. It's just that the market is just kind of tugged by the optimism and the pessimism of the overall trade talks. But this kind of gives us a snapshot of where we are in the markets. Again, we're above the 50-day moving average, a little bit of a pullback, not a big deal. Over a longer term perspective, again, we see the fourth quarter of last year, pullback. Again, we're above the 50, still doing well. And this gives you also a bit of perspective on the drawdowns of the market. Again, SP is off 4.2% off its highs, can't even compare to the nearly 20% drop in fourth quarter last year. And again, 2018 was just a historically volatile year where we had 3 times the market was down over 10%, one nearly 7, and one down nearly 20. So just last year, the markets were just kind of whipsawed all over the place. And you know, we actually learned a lot from that, and I'll share some of the lessons that we learned in just a few minutes. But you know, just kind of give you some idea of the number of the days that SP was above 1% just in 2019 was about 6. Actually above 1%, 9, and below 1%, 6. And in 2018 we had 32 days above 1% and 32 days below 1% in terms of, I guess, 1% either rise or fall is what I meant to say. So anyway, SP number of days of corrections as of today, we've had 13 days of correction. 2018 we had 28 days of correction. So again, the market's just whipping us all over the place. That's just sort of the world that we live in. And again, this is just a shot of the long scale going back to the beginning of this bull market, which is in March of 2009. We've seen pretty consistent 10 to 20% pullbacks from, you know, all throughout this bull market we've had since March of 2009. And again, just kind of showing a snapshot of where we are. This is pretty normal. And let's see if I can scroll down a little bit more here. What I like is this volatility perspective. So you can see that, you know, when the volatility spikes, we've had some pretty volatile days in 2019 and 2018. Much more volatile than 2017 when we had a SB up, you know, in the low 20, 22% kind of range. So again, we've seen increased volatility. You know, the main thing that we've kind of learned from the SP doing that, and I'll just kind of, this is the SP 500. I'll just kind of put you on a weekly chart. Is that, you know, again, as I said in the last chart, we've had multiple times where the SP was down 10%. And if I put this on a daily chart and kind of bring this out just a little bit, what was so difficult in the fourth quarter last year is that you had these big drops, then the market would rally, and now it'd start to fade, and start to rally, and then start to fade. And, you know, throughout this whole period, you know, the market's giving all these mixed signals. And the big lesson that, you know, I learned is that it's very difficult to trade that market, because, you know, once you start, you know, getting out, saying, hey, I've had enough pain, you get out, then the market starts to rally, and say, oh, we see an uptrend of the market, and you kind of get in, and then all of a sudden reverse and does it, and you just keep on getting whipsawed over and over again till the bottom falls out, and then you have this, you know, this big kind of rally from that period of time. So that could be very well what's happening here in May, is that, yeah, we've got a pullback. We don't know if it's going to go back up and get whipsawed again. So what you've seen in my trading, if you're a client of mine, is that I have not been trading nearly as much as I have been in the past, just because of this whipsaw effect. So the way I'm playing the market is that I'm taking more broader, I'm looking at sectors on maybe on a 1 or 2 quarter basis versus you know, on a weekly basis. And I am going to be taking slightly, you know, larger drawdowns, just because I don't want to be whipsawed like we were last year over and over again. So again, as I mentioned before, the market's being driven by the algorithms, and you know, there's a lot of selling that moves the market ups and downs, and so sometimes taking a slightly longer term approach and kind of waiting out these periods of volatility can ultimately be better in the long term, just because you're not locking in losses and you're getting whipsawed all over the place. So what I want to kind of show you is just these are all the major indices. I just kind of ranked them year to date, which is doing the best. Here's the Nasdaq. Again, Nasdaq is up 14.6 year to date. It's off over 6% off the high. And again, we're just making up from the losses from fourth quarter of last year. You know, we have not made any. I mean, we've made up ground, but we still haven't made up a whole lot of ground from the highs of last September. Again, one thing that we own in the market is the Schwab U.S. Broad Market. Again, up over 13%, down about 5.72 off its highs in September of last year. Again, we also have the SP 500, which I talked about in detail. Small cap has really struggled. Again, although it's up 12.6 year to date, it's still down nearly 13% from its all-time highs last year. So small cap continues to struggle. International continues to struggle. It's down nearly 14% off its all-time highs. Just look at that. I mean, international peaked in January of 2018 and just fell and never recovered. And so, again, that's one area that we have kind of underweighted, but we've kind of got back into international this year. And taking advantage of some of these rallies, and also just for diversification purposes. I'm going to get into that in just a minute in what we own. We also have bonds, TLT, the 20-year Treasury. Nice rally right here. Yeah, we've seen some choppy waters, but overall the trend is good. And again, we've seen the overall positive trend in the Treasury, as well as the AG, which is the Aggregate Bond Index. And this is for primarily for 2 reasons. One is that obviously the Fed put rates on hold you know, in the last quarter or so, and that is one reason why the you know, bonds have started to rally a little bit. And also, when we have uncertainty in the markets, people tend to pull money out of stocks and put them in bonds. So if the Fed continues to hold and not raise interest rate and possibly lower them, and we still have a lot of uncertainty, and the China trade talk situation doesn't resolve, we should see some more positive returns in the fixed income and bond space, which is good. Another area that has just been totally beaten up is emerging markets. I mean, you look at this, same kind of story, nice rally in January of 2018, big fall, nice little rally, but just things are starting to drop again. So you can see with the China trade talks is that, it's just, I think they're hurting more than we are. So again, we are not currently invested in emerging markets at this point. In fact, that I actually sold our one China position some time ago and replaced that with more defensive positions in the portfolio. So speaking of which, we're going to go to the current aggressive growth portfolio, and these are the actual positions that I own. Again, just kind of ranked year to date the best. Again, we own Finks, which is a global fintech. Beautiful chart right here, doing exceptionally well. One of the things I've been doing is integrating more of what we call ESG, which is environmental, social, and governance. It is what we call socially conscious investing. And Mario and I have done an extensive amount of research and actually are now offering an ESG portfolio if you have some interest. So if you have some interest in environmentally and socially conscious investing, let me know and we can certainly have that conversation with you. So I've been integrating ESG in the current tactical model, and one of them is global clean energy. So we got into it here in April. We've had a bit of a pullback, but again, this is a very, very nice fund, up nearly 20% year to date. Again, part of our core position is the equal weighted Nasdaq, triple QE. Again, technology has kind of had a bit of a pullback right now, but we've certainly seen that. Again, when you have a high-flying sector such as the Nasdaq, it tends to outperform, but it also tends to shed a little more than other sectors when things drop. And we saw the same thing last year when technology got hit. So if you look here in 2018, you can see technology got hit pretty hard as well. So other sectors that we own IHDG. This is one of the more recent purchases, and again, we've had a nice little rally, little consolidation, and it's kind of where we are. So this little pullback is kind of a global phenomenon right now. I think the whole world is a little skittish on the U.S.-China trade talks. One of the defensive positions that we purchased when I sold China was RHS, which is equal weighted consumer staples. You can see that the chart is nice and going in the right direction. Not as much volatility as other sectors. Yeah, we've had a little bit of a pullback in the last few days, but again, we're still in a positive trend. Still very optimistic on RHS. HEDJ is one of our international positions. Again, my international positions, I try to hedge for currency risk, and I try to get as much dividend yield as I can. So between IHDG and HEDJ, I've covered the international growth and value sectors, nice dividends as well as its currency hedged. Again, up 14.71 year to date. SCHB, covered that a little bit. So this is one of our core positions, about 15% of the equity portfolio. Again, up 13.4%. We also see within these, there's one of the technical terms we use is called beta, which is the amount of volatility relative to the S&P 500. So I have a combination of low beta and sort of beta neutral and also high beta positions in the portfolio. The SCHB, S&P 500, SUSA, RSP, the more of the large cap blend positions that we have in the core portfolio tend to have an average beta slightly less. And then we also have a high beta position called ARC, which is our Innovation Disruptive ETF. And again, this is one that is going to be more volatile. It was up in the high 20s until its recent pullback here in April over the last few weeks. But again, it's done extremely well. Again, just before the pullback, ARC was up roughly 40% from its basically the bottom back in January. So again, when things are going well, it's doing really well. Right now, it's struggling a little bit. Hopefully, we've reached some level of support, and we'll continue to go up. If not, again, I'm going to have to look at this seriously to possibly selling that and getting out of the portfolio. But I think my inclination is to keep ARK for the moment. PID, on a category basis, it's probably the top ETF in the international space. Again, it's international dividend achievers. Again, I'm trying to get as much dividends as we can. RSP is equal weighted S&P 500. SUSA, going with my ESG theme, is very much so of the S&P 500 minus potential stocks that don't have a high ESG score. And last two positions, again, going with the ESG theme, we also have CRBN, which is the overall broad market with low carbon exposure. So if you don't like companies that are polluting our environment, this is a good ETF that we own in the portfolio. And finally, the last position that we own in aggressive growth is the Invesco shipping portfolio, mid-cap 400. Again, it's doing fairly well, except for we've had a bit of a pullback in the last few weeks. So again, this is one that's on my short list to sell, but I am, again, being a value position, this is something that you tend to get in and try not to time the market as much. But again, every position needs to be evaluated, and if we lose much more, then we will be replacing this with something else or just kind of leaving it in cash for the short term. Moving on to the bond model. You can see right here, kind of year to date, we have BSJP, which is an asset allocation ETF of multiple bond sectors, doing very well. It's kind of going sideways right now because it has some exposure to high yield, but again, that historically has done very well, and it's going to remain in the fixed income portfolio at least for the short term. IGIB, which is the short-term government bond fund, doing very well. Very happy with that. Have no reason to sell that. BYLD, again, the high yield optimized bond. Again, having some exposure to high yield bond is a good thing to have right now. Again, when stocks are doing well, high yield tends to do well. And this is one reason why high yield has kind of slightly underperformed in the very recent history, is because it tends to be a little more correlated to stocks. And so, as I said, if we take a longer term approach, a quarter or two at a time, I'm still bullish on equities and high yield, so that will remain in the portfolio for some time. SCHP, our TIP fund, again, this also falls in the ESG category. Doing very well. Again, TIPS stand for Treasury Inflation Protected Securities. Again, beautiful chart. We'll continue to own TIPS. TLH is, again, the 10 and 20-year Treasury bond fund. Again, very similar to TLT. Nice returns, up nearly 4% year to date. Nice trend. I'm going to keep that. And also we own SUSB, which is an ESG short-term corporate bond fund. Again, doing well. It's kind of going in a sideways fashion at the moment, but overall it's up 2.45% year to date. Good Morningstar score and a nice dividend, and also we want to stay on the shorter end of the duration pool with bonds. The other thing is that what's not on this chart is 30% of the bond portfolio is in a Schwab money market account, and it's yielding on an annualized basis a little over 2%. So I've got 30% of the bond portfolio in a Schwab money market that's 100% liquid, has very competitive yields, and it's also reducing the volatility within the portfolio itself. So those are the positions in the in the tactical models. One thing I'm very quietly releasing to my clients is an ESG portfolio, and again, if you have some interest in that, feel free to give me a call or send me an email, and I can talk to you about moving to the ESG allocation. But it is now officially in swing, and again, all of the positions here in the ESG portfolio meet the high ESG standards. So we also have the Neuberger and Berman, the Nuveen mid-cap doing well, up over 20% year to date. ICLN, which we own in the tactical model, We own the John Hancock multi-factor technology, which kind of replaces my triple QE position in the tactical model. IHDG is in the tactical model, HEDJ, PID, SUSA. We also do have ESGU, which is similar to USA, which is, again, a large cap blend, USA ETF. And SCHD is a large cap value with a super nice dividend. So that is the current ESG portfolio, doing very, very well. I'm just literally launching it as we speak. If you have some interest, call the office and we can certainly set up a call to kind of talk to you in a little more detail about that. So that's all I have at this point. Again, you've got my number, 301-588-0514. Send me an email if you like. If you like to schedule a review to go over your accounts, I'm happy to do that with you. Again, we are doing Social Security workshops every month, so we're doing basically 2 a month. Coming up this Thursday, the 30th, we've got one in Bethesda, and the following week in Bethesda, and also in July, we are going to be back at the Dolly Madison Library in McLean. I think I'm going to take August off, then kind of kick it back up in September. So anyway, hope this was helpful to you to kind of give you a good idea of what's going on with the markets. Again, happy to answer any questions that you have, and if you have any questions or concerns, again, my door is open. Love to talk to you. And in the meantime, have a great week, great summer, and I will catch up with you soon. Take care. Bye.